In this video, we're going to basically define what's meant by the goal of external stability and discuss in a bit more detail the relationship between the CAD and net foreign debt and what are some of the issues of having a high level of net foreign debt. So the goal of external stability is about limiting the imbalance between national spending and income. It's all about being able to pay off our future financial obligations. So we don't want to go into too much debt. The way that we measure the goal of external stability, it's kind of got three subsections. It means we have a sustainable current account deficit. Generally, it needs to be below 5 to 6%. If it's above 5 to 6%, it becomes really dangerous. We prefer it to be around 3%, but generally below 5 to 6%. You don't need to quote the percentages when you define this goal, but as long as you say that the goal of external stability means having a sustainable current account deficit, a serviceable level of net foreign debt. So it can be high, but it has to be serviceable. It can't be too high that we can't pay it back or that we can't service the interest on it. In fact, we're never going to pay it back. We just have to be manageable and be able to pay the interest that we need to pay on it. And a relatively stable dollar. So the goal of external stability is measured in three ways. It's about having a sustainable current account deficit, a serviceable net foreign debt, and ensuring stability of the dollar. So it doesn't go up and down by too much. These three measures are closely related and can have impacts on each other. The higher our current account deficits, generally the more our net foreign debt will increase. And that can affect the value of the dollar as well. Explain why CAD and net foreign debt are problems for Australia. A high CAD and net foreign debt can lead to increased interest repayments. So it can make it hard for us to repay our debt because we have to pay so much interest, and we have to basically have so many credits in our in our current account. There'll be too many debits. There'll be too many debits in our current account. When we are in a lot of debt, we have a high level of net foreign debt. We're paying a lot of interest, so there are a lot of debits in our current account. A high level of net foreign debt can also reduce confidence in Australia. It can mean a reduction in our credit rating. So if we go into too much debt, just like if you go into too much debt, our credit rating will fall, and that can lead to higher interest rates on our foreign loans. And it can also mean that people refuse to lend to us altogether. And the problem with other companies refusing to lend to us altogether is that we need that money for investment. We need that money to boost our productive capacity so we can boost productivity and grow in the long term. So if our credit rating becomes too poor, or we get into too much debt, then other countries may increase their interest rates on their loans, or they refuse to lend to us altogether. A high net foreign debt can lead to less capital inflow because people don't want to lend to us. And that can depreciate the dollar because essentially there's less money being converted into Australian dollars. Outline the relationship between net foreign liabilities and current account deficits. So I'm going to talk a little bit more about net foreign liabilities on Monday. But basically, the higher Australia's current account deficit, the more we have to borrow or sell assets to other nations. So if we have a higher current account deficit, it means we're spending more than we're earning, and therefore we need to borrow or sell assets through the financial account. A higher CAD will therefore increase net foreign liabilities. Whenever we run a CAD, we will have high net foreign liabilities because we either borrow or we sell off our assets. An increase in net foreign liabilities is likely to lead to a higher CAD in the future because we're going to be paying interest on our debt and paying dividends and profits if we sell companies or sell shares in Australia. So there'll be lots of debits, particularly in the net primary income account of the current account because of high interest and dividend repayments. So we're looking at the relationship both ways. A higher CAD can lead to higher net foreign liabilities because we borrow and sell our assets. Higher net foreign liabilities can, on the inverse, impact the CAD because once we have more liabilities, we're going to be paying more interest and more dividends on our debt. Why net foreign debt is riskier? Net foreign debt is riskier than net foreign equity because if we issue debt, we have to pay that money back and interest repayments regardless of how our economy is performing. So even if our economy is performing poorly, we're still going to have to pay interest on our debt. We still have to pay our debt back. However, if we issue equity, basically they're taking a risk. So if they invest in like Qantas or BHP or something like that, and then that company was to go broke, well, we don't actually owe them money anymore. The value of their shares just falls. So debt can be riskier for Australia because we have to pay them back regardless of what happens in Australia, where if we issue equity, that's not the case. We may not have to pay them back as much because the value of their shares will fall, and therefore it's not as risky for Australia. So debt is riskier than equity because we have to pay them back no matter what. Equity, we don't have to pay them back if the value of their shares falls. Effects of the high current account deficit and net foreign debt on the exchange rate. So I talked about how a high net foreign debt can lead to a depreciation of the exchange rate. And the reason for that is that foreign investors want to reduce their exposure to Australia because they see us as a risk. So that can lead to large capital outflows, which basically means people take their money out of Australian banks and stop investing in our assets. It can lead to higher interest rates on borrowed funds. It can lead to increasing our international debt obligations because there's higher interest rates on them. And it can also lead to a refusal to lend to Australia altogether. So a high net foreign debt can lead to large capital outflows, which would depreciate the dollar, and they lead to less lending to Australians, which can also depreciate the dollar.